Hi everyone, my name's PK, and here I have Mike Mortlock, who is the owner and founder of MCG Quantity Surveyors, and this is all about how you can save money in tax if you are a property owner right now, or you're going to become a property investor. I should say investor, not property owner. So we're going to go through, what is depreciation? How do we actually figure out how much tax we can save? And like the honest truth is, most people don't know this. Most people don't capitalize on it enough. We're going to talk about commercial versus residential, all this good stuff. So if you want to save maybe $1,000, $2,000, $3,000, $4,000, $5,000 in tax every single year, no promises, but let's go with that, then carry on. Welcome to the Oz Property Investment Mastery Podcast. My name's PK, and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. Mike, thank you so much for making time. I'm super grateful.
Pleasure. Now we've got to deliver $5,000 back in people's pockets, or we're going to get cancelled.
Well, let's try our best. Maybe just we'll get to the nuts and bolts, but just for everyone's benefit, like what's your background? Like, what makes you so passionate about depreciation, so much so that you've created a whole empire around it?
It's kind of like, the burden of explanation is on me, right? It's like if you don't drink alcohol, people will say, oh, why don't you do that? Or if you don't eat meat, why don't you do that? It's like, why are you a quantity surveyor? Like, of all the jobs, it's a pretty weird thing to do. I like to sort of explain to people, I wanted to be a fighter pilot. So, I had normal aspirations and then, ended up being a quantity surveyor. So it is a little bit weird, but I guess I always loved property. I had a short 10-month career in real estate and realized as an introvert that doesn't kind of really work as a job. I really like the property side of things. I ended up studying valuation before I moved over into quantity surveying. And I guess I just love the numbers, the analysis side of it. And I've been doing it for, I guess 2 decades now. I'm really passionate about it, as weird as that sounds.
Yeah, and you're probably making lots of friends as clients as well, because, when you save people tax, it's kind of like your business has an incredible return on investment. We'll get into that, but like you spend $500 on a depreciation report and you save $3,000, $4,000, $5,000 a year, like, you're pretty grateful to the person that's given you the report. So that's good. Let's get into it. Like, what is, I know there'll be a lot of people who already know what depreciation is, but to start from the start, like, what is depreciation and why is it important?
Yeah, look, essentially, I like to think of it as an allowance for the wear and tear of your income producing asset. Because when you're a property investor, you're kind of running a business. So the business is you're renting out property. And like all businesses, you can claim expenses that are part of that business. And an expense of renting out a property is that property is going to wear out. The tenant is using the structure, they're using the plant and equipment items inside. So that's where the government gives you an allowance for that decline in value. So we estimate the construction costs and all the values of the fixtures and fittings, depending on where they qualify. And that just gives you a tax deduction. So it's a bit like a student buying textbooks. It just comes off your taxable income. And I think it's important because it just helps with the after-tax cash flow of that property investment. So after tax, depreciation can turn a negatively geared property into a positively geared property. And I think cash flow is one of the hardest things for investors, but especially when they're starting out in their journey. Most people still only buy one property, and I think that's because they underestimate the expenses, and they also often are getting that first investment property wrong as well. But depreciation is just that bonus to help you to hold on to that property and minimize your tax.
Yeah, and especially like in these days with interest rates rising, right? Like your positively geared property now may have become negatively geared because rates have risen 1 to almost 3% in, maybe in the future. So it's incredibly important to understand what depreciation is as a non-cash expense. It adds more loss to your property, but it's a non-cash loss, and you get, depending on your marginal tax rate, you get that back. Now, if I'm like a super skeptic, right? Like, why can't I estimate the depreciation myself? Like, why do I need to spend, I don't know, like $500 to a quantity surveyor? Why can't I just go around the house? Or why can't I work with my accountant and say, look, there's probably, I don't know, $5,000-$6,000 of depreciation on this property?
Yeah, I guess it answers the question when you say there's probably, right? The ATO doesn't like to work in probablys, right? They like to work in facts. Did you probably earn $100,000 at your job, or did you earn $1 million at your job? It's a very different proposition for the ATO. And the reason why accountants can't do it is they're experts in all of the tax legislation, and us as quantity surveyors, we have to be registered tax agents because we're providing a very specific amount of accounting advice. But the reason why quantity surveyors is we generally will have a Bachelor of Construction Management, and we're construction cost estimating experts. So there's really nobody better to say how much something actually costs. So the ATO recognizes us as people that are experts in finding out how much it costs to build something. And we do that, through our analysis and our degree and the projects that we're working on that are coming out of the ground. So that's why the ATO says that you can't really go and estimate stuff yourselves. Accountants do it sometimes, but they shouldn't be doing it, firstly. And if they are doing it, they tend to be very conservative, because if they were ever get audited, the ATO would look at it and go, oh, look, that's way below our benchmarks. We're not even going to touch it. But for a quantity surveyor, we're not conservative. Our idea is to find out, well, what is the most that it could reasonably cost that we can justify? Because we're working for the client and not the tax office.
Gotcha. Okay, so you're experts in the field, which is important when you're dealing with the ATO. You don't want to mess around with them. All right, and so the next question, I guess, feels like an interrogation, but the next question I have is like, like there's all these companies, property companies, that say you should buy brand new property because there's huge depreciation. Like, and that's a fact, right? Like a brand new property will have more depreciation than an older property. But do old properties, in fact, have depreciation on them? How old is too old? And, I'm asking the question from a perspective as well that, everyone knows I like to buy properties with high land to asset ratio, which means that they're not brand new. Brand new, generally speaking, perform, in an inferior basis to established large blocks of land property from a capital growth perspective. So should people be tripping about like, why should I buy a 15, 20, 30, maybe 40-year-old property? There'll be no depreciation. What's the cutoff there?
That's a great question, or a great possibly 6 questions that I'll try and answer all at once, right? So the reason why people that are, let me say, selling or flogging off the plan apartments as an example and using depreciation as kind of a selling point is because, that is probably the main bonus of buying a brand new apartment, for example. And there's a lot of negatives to buying that. Recently, I did a video, I think it went up on LinkedIn a couple of days ago, basically saying, what sort of property should you buy for maximum deductions? And I go on to explain probably the worst investment property you could ever think of. A unit in a high-rise complex of 500, it's got 2 gyms, 3 pools, foyers, furnished, 8 levels of basement. And
tennis courts.
Yeah, exactly. And that's fantastic for deductions, but history has kind of proven that is going to underperform the types of properties that you were explaining. So I like to shock people with that by basically sort of demonstrating to them that depreciation is a bonus. It's never a strategy. Now, new properties generally will provide better deductions than older properties, but I've even heard some quantity surveyors say fact, like new is always better. But think about this as a case study. Think about a brand new, say, project home with a $400,000 construction cost, or you think about something in a blue chip area, some property, let's say in Sydney, it might be in Paddington, or it could be somewhere in Brighton in Victoria, that was built in, say, 1910, but has had a $3 million renovation and it's all schmick, right? that property is going to provide way better deductions than a brand new property. So it's not always the case that new is better. But yeah, typically, if you consider properties that I've invested in, I don't own any brand new properties. I don't own any properties in high-rise developments. And I've even bought a property that's about 18 months prior to the cutoff date for depreciation claims on the original building structure. Now, that could be costing me $1,000 out of my pocket each year if I'd gone that little bit extra. But I wasn't looking for the best deductions. I was looking for the best capital growth with the yield that I was comfortable with. Does that make sense?
Yeah, totally. And so it's 1987, right? The cutoff?
Yeah, the 16th of September 1987. So it needs to have commenced construction after that date. But it's important to understand that if it's built prior to that and it's had renovations or improvements or extensions or anything like that, you'll be able to claim the structural portion of those improvements. And I've been in inspections with clients before and looked around and said, oh, this property was extended. And they sort of say, oh, really? Like, how do you know that? And we go and we have a look under the house and you see some steps going up to the middle of the house. And they're like, oh, that's weird. Why is it doing that? Like, well, that used to be the back door, right? So this whole section is new and the original structure doesn't qualify, but this part does. And that particular example, I think we were talking, $120,000, $150,000 worth of an extension. So, that could be 2.5 plus worth of deductions each year on those improvements.
Yeah, that really adds up, like over the long term. So what I'm hearing is that even if it's an older property, still investigate the potential of depreciation benefits on the property. I guess, like, a lot of people ask me, including clients, they ask, oh, hey, PK, is there like an easy way without having to fork out money? Is there an easy way to estimate, like, should I get a depreciation report? Is there going to be anything in this property? Like, when people are budgeting, they're like, okay, should I buy this property, this property, this property in their cash flow calculator? Hopefully they have a cash flow calculator. They should be plugging in like a depreciation amount. How do they estimate that without sort of, getting an actual quantity surveyor out to the property every time?
Yeah, look, there are online tax depreciation calculators. We held off creating one for the longest time because we've always done it bespoke with actual people, but we couldn't sort of ignore the huge demand for that. Lean on us free of charge to give you an estimate. And I don't really know any quantity surveyor that's going to charge you for a feasibility sort of estimate to say, this particular one, there's not much in it, or this particular one, you're probably looking at 3 to 5 in the first year. So I would encourage you to reach out to a quantity surveyor and develop a relationship with a quantity surveyor, and the good ones should be willing to help you. And it's a difficult thing to understand, but to answer that question in a way that hopefully will benefit people if they're just afraid of reaching out. I don't want to be that
people are super shy, right? They're like, they're I'm not picking the phone.
I get it too. And I mean, that's part of the reason why I think people like listening to podcasts, right? I'll interview, say, a buyer's agent. They want to know, what's their methodology, where do they invest, but they don't want to be on their mailing list, right? So I came up with 3 triggers that tell you that you likely would benefit from a depreciation schedule. And I think that's the simplest way that you can get your head around it. The first one's easy. You buy a brand new property. We can explain why that's better, but I think most people know. The second one is built after 1987, as we just mentioned. That's the cutoff date for the original building structure. The third one is it doesn't match 1 or 2. It's not brand new. It's not built after 87. But it's had improvements. So the previous owner has renovated the property, or even you've renovated the property, and the magic figure is about 40 or 50 grand worth of works. Because if the previous owner did say $40,000 worth of structural works, then that's $1,000 a year worth of deductions. Now, that's not, of course, what goes back in your pocket. It's the marginal rate, but it's probably the break-even point for a schedule being worthwhile, right? So that's probably the best simple advice I could say to someone to get a sense of whether there's been an improvement, whether there's value in a schedule.
Yeah, totally. And like these days, Mike, I don't know if you're feeling it as well, but I feel that there's an increased interest in commercial property. Like, is there any differences in how depreciation works with commercial, let's say with that 1987 rule or anything else versus residential?
Yeah, absolutely there is. And you're right about commercial. You know, the metrics have changed quite a bit. And I've worked with a commercial fund that the individual sort of owners elected to sell their portfolio just because, you know, they've done well out of it and they can't see any returns in similar things. It's completely different. So take, for example, that 1987 cutoff date. That's a residential date only, and commercial has different cutoff dates for the original building structure depending on what it is. So there's a difference between, say, an office and traveller accommodation. There's different rates of depreciation, whether it's, say, a manufacturing premises or whether it's a retail premises. So normally the cutoff date is 1982, but you can have 1979 cutoff dates as well. But the most important difference is the plant and equipment item. So the ATO brings out their tax ruling each normally July. So it'll be something like TR 2022/1. This is the sort of stuff that us quantity surveyors nerd out on, right? It's about 281 pages, and only about 4.5 of them are residential plant and equipment items. The rest is commercial. So depending on the industry that it's in, there's a huge amount of commercial plant and equipment items, you know, all the way down to little dentistry drills and, you know, even in vitro sterilization units in agriculture. So it's crazy how much there is. But I think the most critical difference for investors is that the change that happened in 2017 that says you can't claim plant and equipment unless you buy a brand new property or you install brand new assets, that doesn't apply to commercial. So since 2017, commercial has disproportionately provided better returns than residential has in the established market.
Right, right. Really fascinating. I mean, I feel that there's so much more nuance when it comes to the tax legislation for depreciation around commercial. Yeah, it's like I'm definitely not an expert at it. I would just recommend people reach out to a quantity surveyor, you know, even more so than for residential, but definitely for both. The last question, I mean, there's so many quantity surveyors. I'm sure people have, you know, heard of others and stuff like that. Is there any difference between the different quantity surveys? I mean, like a tax agent or an accountant, you know, essentially they do the same thing, but the advice that they provide around structuring, etc., that's where one, you know, an accountant can be a bit more better than another accountant. Is that like a thing for quantity surveyors, or are you guys all looking at the same spreadsheet and like, okay, this is the property, chuck in the numbers, here's the output?
Yeah, it's a really, really good question. And, you know, from my perspective, there's a huge difference, but I've got to appreciate that from a consumer's point of view, they might say, okay, well, you've all got the same legislation to work within, and you know, construction costs should be what they are, right? But I think there's a huge difference. We're not the cheapest quantity surveyor out there. We're not the most expensive, but we're significantly more expensive than some of them. One of the big kind of turf wars that we're having at the moment is whether a property should be inspected or not. The Australian Institute of Quantity Surveyors has about to release a depreciation white paper that many of us in the industry have been part of formulating, and that's basically saying that if you're not having an inspection completed, then there really needs to be a disclaimer in the report to explain to the client why that hasn't happened. That's probably the first one. Any quantity surveyor that's offering a depreciation schedule without an inspection on an established property, a brand new property with plans and inclusions can be okay. But even then, sometimes it might say stainless steel appliances, and there can be a huge variance between the cost for those, or carpet to living areas. Well, okay, well, is the hallway considered a living area? These things make a difference. That's probably the biggest one. And then I think it comes down to the expertise of the people that are doing the job as well, and the care factor as well. I mean, I can remember back in the day, pre the plant and equipment changes, we'll go to do an inspection. The client's already given us information. They made a few improvements. They didn't mention a hot water system, but we see a brand new one in there and we see an old one on the ground. So we get back in touch with them and say, I can see this old one on the ground. It had its manufactured sticker on there on this particular date. So can you let us know the details of the first one? And what we'll do is we'll complementarily grab that old one and apply a scrapping value for that. So these are kind of little things that you can sort of go, all right, like the client doesn't really know that that's going to be missed, but like we care about providing the best possible result, right? Like it's just one little example where, just having a happy workforce can actually impact the results that the client is going to get. I think that the greatest kind of advantage that I think that we have over some competitors, and I don't want to launch into a sales pitch, but we have an estimating department that works on construction projects as they're coming out of the ground, right? And some quantity surveyors don't have access to that. And the benefit is that we are looking at real world construction costs today. And the pace of change in construction prices has been crazy with the pandemic. We've seen certain things like timber frames going up 75%. So without access to that information, you're relying on, databases or cost tables that are in the past. So that's probably a couple of little examples of why it's different. And yes, we have to work within the same rules, but with a creative mindset, you can look at, okay, well, what are the goals of the investor? Are they planning on moving into the property, or have they already lived in it and they're moving out? What improvements are they looking at? If they're doing a renovation, carpet's going to depreciate at 25%, whereas tiles will be 2.5%. So we can speak to them and give them advice on stuff that they can do to maximize those deductions.
Yeah, no, totally. Like there's a saying, right? What is that? Like, watch your pennies and your pounds will take care of themselves, or something like that.
Yep.
And like that's kind of what I think of when you say all that. Where, just small differences, small changes in how a quantity surveyor works. Instead of being able to get 2,000 a year in depreciation, if you can get 2,500, like, on a marginal tax rate of, let's just say 45%, like that's not, thousands of dollars, but over 10 years, that is actually thousands of dollars. So like, it all adds up. And I think everyone, even if you don't want to use MCG quantity surveys, I think you should, anyone who's watching or listening, you sort of ought to do yourself a favor and at least explore quantity surveying, not as a profession, but to get a depreciation report, and check out Mike Mortlock's podcast. You're an experienced property investor, Mike. Last one, just for the audience, a sort of a sweetener on top. What's one piece of advice that you can give to people based on your own experience in anything property investing?
Look, I think I always come back to, if our podcast has a bit of a mission, and I'm pleased to announce you'll be on the show very soon, it's to change that percentage. It was 72% of people, now it's 68% of people only own one investment property. And I think it's because they get that wrong by getting excited by depreciation deductions or the fancy brochure on this brand new apartment, or listening to Uncle Barry at a barbecue. You need to educate yourself, because this is a big financial decision. And just looking at things like, I'm paying a lot of tax, so I'm going to get this particular property so that I can lose money and claim a deduction based on that. These are crazy short-term, avoiding the stick style things. So I think people really need to educate themselves and take this very seriously, because this can really launch you into the future that you want to have. Think about why you're investing in property, rather than getting caught up in the hot spots of, Ballarat's about to boom, or Logan is giving, 12% yields at the moment. You've got to think about what you're trying to do and take it seriously, because that might mean you retire early, or you spend more time with your family, or whatever's important to you. But, you want to get it right.
Yeah, no, for sure. Well said. And I love that you're all about education as well. For anyone who's watching or listening, check out Mike's podcast as well. Geared for Growth, right? Geared for Growth is what it's called. But thank you so much for making time, Mike. Super appreciate it. Very grateful.
Pleasure. Thanks, PK.